Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, this week was best categorized as volatile consolidation, if there could be such a term. The market really doesn't know where to go at the moment, and I think investors took a good opportunity of a little pause over the Thanksgiving holiday period. And although there was quite a slide towards the holiday itself, on Wednesday the indices lost about 1.5%. Then on Friday there was an equal pickup, so the week ended pretty well where it started. We'd like to tell you that we think the rally on Friday was the start of something bigger. But I don't really feel we can say that. Our feeling is still that there's more selling to come. There was an ominous sign of this really on Wednesday when the S&P 500 index slipped into negative territory for the first time this year. And when you consider that many investments such as mutual funds are pretty well linked to this index, it's not a very good result for the year to date. Another indication of the weakness is Moody's downgrade of such stalwart institutions as Freddie Mac and Fannie Mae in the States. You don't normally see these downgraded, but this week they were. Let's have a look at our chart for the Nasdaq. Well, it's a bit of a different chart we're looking at this week. We feel that this is the week that the bull market ended. The bull market that's lasted over 5 years now has probably come to an end now for a short time, because the selling that's been prevalent in the last several months finally climaxed this week with a massive drop, really. In the space of 3 days alone, from here to where it seems to be settling over the weekend at just over 2,600. The Nasdaq dropped from its peak of 2,850 just over a week ago. That's a massive drop in a short time, on particularly high volume as well, which is very significant. But the most significant part of the fall was its broad-based nature, and in particular the fact that it was the large cap tech stocks that saw the largest drop. Financial sector has been weak for some time now, so a large percentage drop in that was pretty well expected. But the fact that it was the tech sector that really led the way down means that most people are feeling that really the market has gone as far as it's going to for the time being, in the light of the present US economic conditions, all the problems that seem to be mounting out there, and finally succumbed to selling pressure this week. Looking at the scenarios we have in place, we now feel that the two main scenarios to be looking at is the one that we mentioned a few weeks ago when this top was first being formed, and we drew a channel line. If I can just put that in again for you, a channel line about there representing that top, and then we looked at where there was considerable support for the market 3 or 4 months ago when we had a correction at that time, and this is the line really that was formed at that point, a support line down at just about the 2,500 level, just slightly below really. But if we go back, we see that this line extends way back as well to the beginning of the year, where there was a large support level here, and at the time it formed a barrier really for the market to go further up. There was a small correction before the market then took off in good style, which has really been the bull market of the last year, which we feel now has come to an end. The other scenario to look for really is the formation of a head and shoulders pattern, this being the left shoulder here, and this being the head forming, and of course the right shoulder should be forming out here in the next few months. This will then really give the impression that the market, even in the new year, is liable to take a further downturn to complete that head and shoulders pattern. If the channel lines simply form, The market may well just operate between these channel lines for the next few months, which will be a better scenario for the market, of course, if a longer term period of consolidation is the result of this sell-off and not the start of a much longer downturn pattern. Well, I wonder how the start of the holiday season shopping went over the weekend. Friday, of course, is known as Black Friday because it's usually the day that most retailers go into the black for the year. But the general consensus is that it's going to be tough trading conditions, business conditions going through the whole holiday season into the new year, and really depends on how well the US consumer stands up. If retail sales really start to weaken badly and consumer spending really does drop, then I think we're in for a little bit more of a recession than just a slowdown. Of course, the Federal Reserve may well try and step in again to bolster things up a little, and there is talk on the street of an interim rate cut as a possibility. This would certainly give the markets a bit of a lift, but there's still an awful lot of bad news out there. The brief rally on very thin volume, as most of the main market participants were away on holiday on Friday, was probably just an aberration. We don't think that it'll amount to much of a rally this coming week. But should this translate into a bit of a rebound rally, then we do feel the advice given to you last week of selling the peaks, selling into any strength that develops, would still be probably the best policy. Well, we wish you a happy holiday weekend from all here at Ferrari Financial, and until next week, it's goodbye from London.